The market crashes, headlines scream recession, and everyone rushes to pull out their money. But while most people are panicking, the wealthy, they're quietly buying. This video reveals the exact blueprint of how the rich not only survive downturns, but come out wealthier than ever. If you want to know how to turn financial chaos into real opportunity, don't go anywhere, because this is how the wealthy turn downturns into fortunes. Let me tell you a story that isn't in your average finance textbook. In 2008, as the housing market collapsed and fear was spreading faster than the flu, a man named Jeffrey Jandelle quietly stepped into the chaos. While the news warned people to get out, Jandelle doubled down on distressed financial stocks and oil positions. The result? In less than a year, his funds soared by over 80%, and he wasn't alone. While the average investor pulled out their 401k and held cash, wealthy insiders went on a shopping spree. The reason? They weren't guessing. They had a framework for moments like this. So ask yourself, in a downturn, do you retreat like the herd or reposition like the wealthy? Because understanding this shift could be the single biggest financial advantage of your life. If you want smart, real-world wealth-building strategies like this one, hit that like button, subscribe, and let's keep moving. We're about to break down exactly how the wealthy turn downturns into money machines. Let's kick things off with where we are right now. The market feels shaky. We're seeing inflation cooling but not gone, interest rates staying higher for longer, and uncertainty over geopolitical tensions. Tariffs are heating up, and consumers are pulling back. Yet asset prices remain elevated. It feels like we're sitting on a bubble, or at least a balloon stretched to its limit. Now here's what most people are doing. They're cutting expenses, hoarding cash, and waiting for the all clear to come back into the market. But here's the catch. The all clear never comes with a big announcement. By the time it feels safe, the opportunity is already gone. Meanwhile, high net worth investors are doing the opposite. Private equity is quietly buying into distressed commercial real estate. Hedge funds are betting on undervalued tech. Sovereign wealth funds are increasing exposure to U.S. equities while retail investors are pulling out. A recent Goldman Sachs report showed that the top 1% of investors increased equity positions during the last 3 market corrections. Why? Because downturns are discounted marketplaces. As Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." All right, let's move on to the next asset that sets the wealthy apart, their mindset and strategies. This is how the wealthy turn downturns into money machines. They do 3 things exceptionally well. First, they stay calm. Emotion is the enemy of compounding. Where others see chaos, they see discounts. Second, they build war chests. They keep a portion of their portfolio in cash or short-term bonds, not to play defense, but to buy when there's blood in the streets. Third, they don't try to time the bottom. They dollar-cost average into great companies and assets over time. No bells, no whistles, just patience. But the real secret sauce? They have conviction. The average investor might know about Amazon or Apple, but the wealthy understand the business model, the cash flows, and the leadership. During the 2020 crash, while most retail investors fled, billionaire Ron Barron bought more Tesla stock. Why? He wasn't guessing. He understood their long-term potential. That position? It turned into billions. The takeaway? The wealthy don't need perfect timing. They need clarity, consistency, and capital. Coming up next, we'll explore 3 compelling real-world examples from the past, one of which might just surprise you. All right, let's talk about real people who turned recessions into riches. You already know Warren Buffett bought American Express during a salad oil scandal and saw a massive return. But here's the story you might not know. In 1990, the Canadian real estate market took a brutal hit. While most fled, a quiet investor named Prem Watsa started acquiring insurance and real estate assets at deep discounts. He didn't buy flash. He bought broken but fixable businesses. Today, Prem is often called the Warren Buffett of the North. His net worth? Over $1.5 billion. The pattern is consistent. Buy when prices are irrational. Sell when confidence is overflowing. And sometimes, it's not even about stocks. During the 2008 crisis, wealthy families began accumulating farmland, art, and private business equity. Why? Because they knew inflation would come and tangible assets would outpace cash. These stories aren't about luck. They're about framework. As Jim Rohn once said, "Success is neither magical nor mysterious. Success is the natural consequence of consistently applying the basics." We're about to show you how to apply those basics in your own plan. Now let's talk execution and outline actionable strategies tailored for individual investors. Are you ready? This is how the wealthy turn recessions into money machines, and here's how you can apply the same principles. First, automate your investing. Use a robo-advisor or brokerage platform to dollar-cost average into ETFs like SCHD, VTI, or Dividend Aristocrats. Even in a bear market, this helps you build positions at lower prices and avoid emotional decisions. Second, keep dry powder. That means 10 to 20% of your portfolio in high-liquidity assets like short-term bonds or money market funds. Not to time the market, but to have ammo when everyone else is paralyzed. Third, shift your metrics. Instead of looking at price, track your share count. Are you building ownership? Are your dividends increasing? That's the game. That's how the wealthy think. Fourth, train your brain to filter the noise. Follow 13F filings, the quarterly disclosures from institutional investors like Berkshire Hathaway. They show you what the biggest players are buying and holding. This is data, not drama. And lastly, consume better information. Avoid panic-driven headlines and social media fear loops. Instead, study long-term economic trends, investment books, and macro research that help you understand cycles. By the way, if you're enjoying the video so far and want more topics like this, comment the word "more" so I know. All right, moving forward, let's build a full-circle framework that turns these insights into action. Step 1, build your opportunity fund. Set up automated transfers, weekly or monthly, into a high-yield savings account or short-term treasury fund. This is your dry powder for scooping up discounted assets. Step 2, pre-select your shopping list. Create a watch list of high-quality, dividend-paying stocks, undervalued ETFs, or cash-flowing REITs. Prioritize fundamentals like consistent earnings, high return on equity, and manageable debt. Step 3, set your strike zone. For instance, when one of your picks drops significantly but maintains its earnings and moat, you buy more. Simple rules reduce emotional missteps. Step 4, measure income. Track how much cash flow your portfolio generates. Use tools like ShareSite or Empower to visualize your dividend income each month. Progress isn't just about price, it's about cash flow growth. Step 5, make it a ritual. Do a portfolio review on the first weekend of every month. Adjust your contributions, rebalance if needed, and stay aligned with your long-term goals. Step 6, keep learning. The wealthiest investors treat financial literacy like a muscle. They train it constantly. Subscribe to newsletters, read one investment book a quarter, and follow recession playbooks used by top institutions. This framework isn't about being flashy. It's about being unshakable. The wealthy don't act on fear, they act on frameworks. And coming up next, we'll talk about a powerful tax strategy you can use right now to boost your long-term results, especially during a downturn. Now, let's unlock a strategy the wealthy love but rarely talk about: tax loss harvesting. During a downturn, not all losses are painful, some are tactical. Tax loss harvesting means selling underperforming investments at a loss, then using that loss to offset capital gains. Smart investors do this every year to reduce their tax bill. Here's the kicker. After selling, they often rebuy a similar asset, keeping their portfolio intact while locking in the tax advantage. This isn't tax evasion, it's tax optimization. And for the wealthy, this can mean thousands or even millions in preserved capital. Platforms like Wealthfront and Betterment automate this process, but even DIY investors can take advantage of it using brokerage tools. Tax loss harvesting isn't sexy, but it's smart. It's another reason the wealthy come out stronger after downturns. They squeeze value from every corner of their portfolio. What's more, the IRS allows up to $3,000 of these losses to be used to offset ordinary income each year, further enhancing its long-term benefit. Over decades, that's a silent wealth builder. And the smart play? They don't wait until the end of the year. They harvest throughout market dips, maximizing their deductions when others are still waiting. Up next, we'll talk about another advanced yet approachable move: private investing during recessions. When public markets dip, the rich often pivot to private deals, private equity, startups, real estate syndications. These opportunities aren't listed on Robinhood, but they're everywhere during a downturn. Here's why it works. Valuations drop, founders are open to better terms, and real estate sellers are more flexible. Smart investors step in while the competition steps out. Even accredited investor platforms like Fundrise, Yield Street, and AngelList make it easier than ever to access these deals, even without millions. Private investing isn't just about return, it's about access. And downturns open the door wider for those who are prepared. What most people miss is that these opportunities aren't exclusive to billionaires anymore. Many of these platforms have dramatically lowered the barrier to entry, allowing everyday investors to buy into income-producing assets or fractional ownership of commercial real estate. And here's the twist. These assets are often less correlated to the volatility of public markets. That means while your stock portfolio takes a hit, your private investment in a logistics warehouse or a cash-flowing rental property might stay steady, or even increase in value. Savvy investors don't just think about gains, they think about resilience. Diversifying across public and private markets during economic shifts isn't just smart, it's essential for long-term growth. Coming up next, we'll close with the one thing you need more than money to win this game: conviction. Let's end with this truth. Conviction is what separates dabblers from dynasties. The wealthy don't just invest money, they invest belief. When things crash, they don't flinch because their strategy is built on principles, not headlines. Conviction doesn't mean ignoring risk. It means doing the work to understand what you own and why you own it. It's studying companies, learning market cycles, building systems, staying consistent. In downturns, your emotions will scream, sell, but conviction whispers, hold, buy, build. Your job? Listen to the whisper. Because this is how the wealthy turn downturns into fortunes, not just by moving money, but by moving differently. Conviction isn't loud, it's quiet, methodical, and rooted in clarity. It shows up when you set your auto investments, even when the market is red. It's in checking your dividends when others check the headlines. It's choosing consistency over chaos. And here's the thing. Conviction is built, not born. It grows every time you stay the course instead of panicking. Every time you research a company instead of watching the news. Every time you think long-term when everyone else is thinking next week. So build that inner compass. Because in the end, wealth doesn't come from guessing right. It comes from getting the basics right over and over again. And conviction? That's the muscle that lets you keep going when others quit. We've just walked through what most people never learn until it's too late. This is how the wealthy turn. Downturns into fortunes. Not with secret stock picks or luck, but with discipline, vision, and smart strategy. You learned how to, first, see downturns as discounted opportunities. Second, use tax loss harvesting to your advantage. Next, tap into private markets when fear sets in. Finally, build conviction when others crumble. But there's one thing even more important than strategy: execution. You see, the people who come out of downturns richer aren't the ones who knew the most. They're the ones who acted when it was hardest. They didn't wait for a perfect time. They made a plan. They trusted the system. They trusted themselves. So here's the question. Will you retreat when the next storm hits? Or will you lean in and build? Because this isn't just about growing your net worth. It's about claiming your power in a world that constantly tells you to fear the future. And just a reminder, the wealthy don't win because they're lucky. They win because they prepare while others procrastinate. They think long-term while others think next week. This is your moment to join them, to build something that outlives the next headline. Because building wealth isn't about timing the top. It's about owning your strategy when everyone else is panicking. You've got this. Remember, this video is for educational purposes only and does not constitute investment advice. It is important to conduct thorough research and consult with financial professionals before making any investment decisions. The value of investments can fluctuate, and past performance is not indicative of future results. Always assess your risk tolerance and investment goals before allocating your capital. Now, if you want to know about other assets that will make you earn money, I recommend you watch this video next. Thank you for joining us today. We hope you found this video informative and exciting. If you enjoyed it, give it a thumbs up, share it with your friends, and don't forget to subscribe to our channel for more wealth-building content. Until next time, may your financial journey be prosperous. See you in the next one.